would you file a claim for $3,000 with a $500 deductible?
Yeah.
Meaning you would recover $2,500. I'm just curious, Pierre, would you file that claim?
$500 deductible. I mean, $2,500. Yeah. What am I not considering here? Yeah, because up front it just seems yes. Hey everyone, welcome to The Remote Investor. I'm Pierre Carrillo, and today I'm with my co-host,
Michael Albaum.
And today we're going to be talking about homeowners insurance, what's happening in the space and what we can do to maybe save some money in this area. So, Mike, earlier this year, our insurance completely dropped us. They stopped serving California. And when we found new insurance, our rate nearly doubled. Why is this happening? What is going on?
Man, well, welcome to the world of so many people like yourself. So this has been happening, and a lot of our listeners may have caught this in the news, but there was a bunch of carriers that pulled out of actually a bunch of different markets. Florida, Texas, and California are kind of the big three that are under fire right now. And you and I are both in California, so you lost your homeowner coverage in California. So basically what we're seeing is that these insurance carriers are taking incredibly significant losses in these three states: Florida due to hurricane, Texas due to freeze, and California due to wildfire. And so what they've decided is essentially, we don't want to do business in those states anymore. These states aren't profitable for us, yet they're driving all of our losses. Let's just pull out entirely, focus our efforts elsewhere, and hopefully recover some of those premiums, those premium dollars that we're losing from California, and also the lost dollars that we paid out in California, Texas, and Florida.
Okay.
And so real quick, for anybody that's maybe not familiar with insurance, since that was me before I got involved in the industry and before I got involved in investing. So when you have premium, is essentially the dollars that you're paying to the insurance company to provide you with the coverage. You pay them premium, you're buying a service from them, or essentially it's an insurance product from them. The service or product you're receiving is insurance coverage in the event of a covered loss or a covered claim. So like for you, instance, you paid your insurance to your insurance company, you paid your premium to your insurance company, and in the event of your house burning down, which is a covered peril, the insurance company would pay you to either rebuild the house or cut you a check so you can go live somewhere else. If you decide to ultimately rebuild or not, is usually up to you. But so you paid them all this money for the years that you were insured with them, and then they just kind of cut and ran. And you don't really have anything to show for it, which is a real drag and a very common tale amongst people living in these states or investing in these states right now.
I know that there are certain things that that insurance doesn't typically cover. I think flood and earthquake insurance are additional costs on top of the typical coverage. Why wouldn't they just remove fires as a covered peril and continue to service the area? What is the reason for cutting and running completely?
Yeah, it's a really good question. And I'm so glad you brought that up, because I think it's something that catches a lot of people off guard, especially after the fact. If someone experiences a flood or an earthquake and then has damage to their property or home and then goes to file a claim only to find out that those things aren't covered. So fire was originally the original peril that was covered when insurance at its inception. So when insurance was first kind of piloted or pioneered, it was because of fires. And so people were essentially pooling their money together. And just a quick little history lesson about insurance. Basically, there were people getting together that said, hey, actually, I think technically, if we want to be specific about it, it was, I think, the Egyptians who first invented quote unquote insurance. And it was, they were losing goods at sea. And so they said, hey, let's pool our money together. It was either the Egyptians or the Phoenicians maybe that came up with this concept. But fast forward to today, insurance has been around for a very long time, and fire was really the risk. And so people got together and said, hey, let's pool our money together. And if we have buildings that burn down, now we'll have this fund available in which we can restore our buildings to the original state. So fire is kind of the OG peril when it comes to insurance. And so in theory, to getting back to your question, you could say, okay, well, California, for instance, because we have such bad wildfire exposure, insurance companies say, we're not going to cover wildfire. Well, let's say you have a house burned down in a neighborhood. How do you prove if it was due to wildfire on the outside or somebody was smoking on the inside and fell asleep and set their house on fire? So there's cause and origin investigations, and man, we are really getting into the weeds here when it comes to insurance. But there are cause and origin investigators, which basically that's their job, to determine how a incident occurred and what caused the loss, what was the initiating event. With fire, it can be very challenging to determine, okay, the entire house is burnt down, maybe just the chimney is left. Was that caused by an internal fire or an external fire? That can be pretty challenging.
How can we mitigate some of these rising costs in insurance?
Number one, like first and foremost, I would say is you have to shop your insurance policy and your insurance carrier on a fairly regular basis. Now, these are annual terms, annual policies. So every year you get what's called a renewal from your insurance company. And it's them coming to you and say, okay, Pierre, last year, these were the coverages that you had, and these were the limits that you had, and this was the cost. This was the premium that you pay. This year, there's typically what's called an inflation clause or an inflation guard. And so they increase the coverages that you have because to rebuild your house this year is likely going to cost more than it would have last year. So you need higher limits. So they say, okay, here's your new limits and here's your new deductible. And for those who are unfamiliar, deductible is essentially the amount that you have to pay as the owner before the insurance kicks in. So just like a medical deductible, if you have medical insurance, you might have $1,000 deductible where you have to pay $1,000 over the course of the year before the insurance will start covering your medical expenses. Property insurance, homeowners insurance, is a little bit different. It's on a per event basis. It's not on an annual basis. So if you have $1,000 deductible and you had a tree fall in your house and that was a covered event, you would have to pay the first 1,000 of that repair, and then the insurance would kick in. So the insurance company at the renewal says, okay, here's your limits, Pierre, here's your deductible, and now here's the premium. And so the levers that we can pull are kind of those three. We could also play with coverage, the different coverages that you add or subtract to the policy in order to manipulate what the cost is going to be. So we want to shop it first and foremost. We want to shop apples to apples coverages across multiple insurance carriers because there are some that just happen to be cheaper than others for the same exact coverage. Now, I will say you want to be very mindful of which insurance company you ultimately go with and look at their ratings and reviews online and see if they actually pay their claims. Because you'll see online a lot of people will pay a lot of money to these insurance companies and then get their claims denied. And the whole reason we have insurance is for when we need them. For when we have a claim, they should be there. So I'm kind of of the mindset that the cheapest isn't always the best. I'm really much more concerned with, do they pay their claims? What does their claims handling process look like? And are they reasonably priced? Because I've been in situations where I had insurance, I had a loss, the insurance company didn't pay. I've talked about it on prior episodes. It was just an absolute nightmare for like years dealing with this insurance company. So had I paid a little bit more for insurance, I could have gone with a more reputable company and hopefully avoided that situation. Hindsight's always 20/20. But so shop the coverages, shop the carriers, then change your deductible. You can get multiple quotes from the same carrier at different deductible levels, and they tend to exist in increments of $500 or $1,000, depending on the carrier. Typically, we'll see $500 deductible, $1,000, $2,000 to $2,500, $5,000, and $10,000 tends to be the typical thresholds. And again, remember, that's the amount of money that you're on the hook for before the insurance kicks in. There's two schools of thought that we can get into in a minute about deductibles, but did you want to ask a question?
Yeah. So going back to the companies that you say are kind of less than willing to pay out when you have a claim, is there any legal recourse or any resources available to you to kind of make them do it? Because they did sign an agreement with you. What can you do if they're giving you difficulties?
Yes, I'm so glad you asked the question. So in the event of a claim, you want to go call what's called a public adjuster. This is someone who essentially goes to bat for you on your behalf against the insurance company. Because you and I are individuals, I'm in the insurance industry and I went and hired a public adjuster. So you can imagine if somebody isn't involved in the insurance industry, they can often play games. And that's not every insurance company, but a lot of times they'll play games and they have more money than you do and they have a bigger legal department than you do. So they can afford to wait you out and play these games. So a public adjuster is somebody, typically they're paid on commission, which means they get paid as a function of the amount of money that they recover for you, which, talk about aligning incentives, is a great person to have on your side,
so they don't
on
get
your
paid
team.
if you don't get paid.
Nope.
Okay.
So they are going to make darn sure they are working on your behalf to get you paid. So I've used several public adjusters. I've had nothing but great experiences with them. They've earned every dollar that they've made, and I was happy to pay it because at the end of the day, their fee, what I paid, I would have recovered way less money had I not used them to begin with. So worth every dollar. But again, you go make sure that you are looking for ratings and reviews for your public adjuster. I'm personally happy to make recommendations. If you're someone that's listening to this and you're like, holy crap, I'm in the middle of a claim right now, or my buddy just had a claim, reach out to us in the show notes. Would love to hear from you. I would happily share my recommendations for those public adjusters. So that's kind of the legal. I mean, you could just sue them. You could just take them to court, but most of the time that's going to be overkill. And then you got to go hire an attorney, and they're
They're not
probably not
commission
going
based.
to. Yeah, like you got to pay whether you win or lose. Now there might be attorneys out there that advertise you pay nothing unless you
Yeah.
win, right? And that's cool too. But I found from my experiences, like public adjuster is a great first step, a great way to go.
And would you say that every claim you should just get a public adjuster for? Or is there a certain threshold or particular case where it starts to become much more relevant that you engage with them?
It's a really good question. So the way it works is typically like this: is you have a claim and you file that claim with the insurance company, and the insurance company comes out and looks at the damage and surveys the damage and says, okay, this is what we think we need to pay you based on the damage. So I've heard stories from numerous people that said, hey, the insurance company came out, told me how much it was, and that was spot on, and it was great. They were very easy to work with. The adjuster was great, very friendly. Flow of communication was very regular and constant. So in that instance, you might not need a public adjuster. But for me, that didn't happen. I was given the runaround. They were trying to pay me 10 cents on the dollar for what I was owed to repair the damage because I had quotes. I had quotes to repair the damage that were nowhere near what the insurance company was offering me. So then I said, okay, I have to go hire someone to help. And in that instance, they were paid based on the delta that they were able to recover on my behalf. So the insurance company said, let's say for instance, here the damage is 30,000. My public adjuster said, no, it's 100,000, meaning they got me an additional 70,000. So they were entitled to a percentage of that.
Okay.
Versus in another instance, I got a public adjuster involved in a fire claim that I had from day one because they handle the entire claims process for me. They go out, they meet the adjuster, they talk to the adjuster, they deal with the insurance company on my behalf. Then I just paid them a flat rate based on whatever was recovered. But again, I was happy to not have to deal with the insurance company. So there are different models out there. I would say for anything north of, $15,000, $20,000, I would think definitely about having a public adjuster at least in your back pocket. Have the conversation with them, explain to them what your claim looks like, and then you can decide about whether or not to involve them and at what stage of the process you do or don't want to involve them. Because like I said, there are claims that go very smoothly, and then you don't want to be paying a fee unnecessarily if it's going to go well to begin with. But for bigger claims, I would say the ones where the insurance companies really don't want to pay out, it's definitely start thinking about it. And again, it's always worth a phone call.
Can you bring them in at any time, or is there a cutoff? Is there a certain level
Yeah.
of?
Yeah, totally. I mean, you can bring them in anytime, and it's totally at your discretion.
Okay.
Totally at your discretion. But again, I would have that phone call sooner rather than later because you get to decide push the go button or not. And so having them kind of in your back pocket, prepped and ready to go, as opposed to you're now 2 weeks into this claim. Oh shoot, it's not going well. What do I do? Who do I call to help me out? Now you're scrambling to go interview and screen public adjusters versus you doing that day one. As soon as the claim happens, they can be up to speed, ready to be plugged into the situation when things start going south, if they do. All right, Pierre, I just got to give a quick little plug. I don't know if I told you, but I just launched MyFi Academy. It is a one-stop shop for all things real estate investing. I am on a goal to help 1,000 people purchase their first investment property. And so come check us out, myfiacademy.com. We've got online lectures, we've got coaching, we've got community, we've got resources, everything that I wish I had access to when I first started investing. So come check it out, myfiacademy.com. I know I'll see you in there, man.
Cool. I'm sorry, just kind of derailed the conversation with that public adjuster tangent, but
No,
you were
it's
going.
great.
Where were you going before I push this off?
So we have multiple levers that we can pull because the
Okay.
question is, what can we as investors or homeowners do to change the cost of insurance? Because the cost is really what's killing a lot of investors out there. And so first and foremost, we said we can shop the quote, go to different insurance carriers and compare apples to apples coverages. Second is change the deductible. And the deductible, you can take a bigger one, which essentially tells the insurance company, I'm going to put more skin in the game. I'm going to be on the hook for more dollars before you ever have to come to my rescue. And so we just have to weigh what that option is. And so when you're getting quotes, go get a quote at three deductible levels. Same coverage from the same carrier, but get it at the lowest deductible, the next highest, and then the next highest, and see what that does to the premium. And so let's say their deductible thresholds happen to be 500, 1500, and 2500. Those policies will have different premiums associated with them. And then you can decide, okay, am I willing to take on additional risk, financial risk, in order to save some dollars, some premium dollars? And only you as the owner are in a position to decide what makes the most sense. The thing to keep in mind is the question you need to be asking, when would you actually use your insurance? So let's say you had a $500 deductible and you had somebody drive into your front door, let's say. Not a ton of damage, but let's say it was $3,000, right? You had to do some siding repair, you had to replace the door, there was some flooring damage, some painting damage. Let's call it $3,000. Would you file a claim for $3,000?
With a
And if the
500
answer
on.
is
Oh, okay. You're just kind of.
with a $500 deductible,
Yeah.
meaning you would recover $2,500. I'm just curious, Pierre, would you file that claim?
$500 deductible. I mean, $2,500. Yeah. What am I not considering here? Yeah, because up
The
front
thing
it
to
seems
remember
yes.
is that every claim you have is likely going to drive up your insurance costs the following year.
Mm.
The other thing to remember is that if you have claims on your record, the insurance company sees that as a demerit, so to speak. And there are certain insurance companies which will not take you on if you have claims of a certain size or potentially claims at all on your record, which is kind of astounding when you think about it. So you could have a State Farm, for the sake of example. Let's say you're with Farmers, you have somebody run into your house, and this person doesn't have insurance, so you can't go after them, and $3,000 in damage. You file the claim. Farmer says, okay, here's $3,000, or here's $2,500 because it's $3,000 damage minus your deductible, leaves you at 25. They cut you a check for 25, and then next year your insurance goes up by $1,000 a year. And you're like, holy smokes, this is crazy. I don't know if that was worth it. So now you go shop that policy. You go to State Farm, and they go, oh, Pierre, I'm sorry, but you have a claim on your record. We're not willing to take you on. And you're like, crap. Well, now I'm stuck paying an extra $1,000 a year to Farmers, and I only got $2,500 out of the claim to begin with. Maybe I shouldn't have filed that claim. Mm-hmm. And so the part of the tricky part of all of this is that you can't go to Farmers and say, hey, Farmers, if I file this $3,000 claim with you, what is my insurance going to increase to next year? It's kind of a black box. And so they're going to be looking at all that stuff during the renewal process and determining, okay, well, Pierre had this risk or this claim on his record. Now we got to recover those funds because we paid out more than we collected. Or even maybe they didn't. Maybe they paid out less than they collected, but now there's a claim and you're now perceived as a higher risk. So we want to be weighing these options, which sucks to have this conversation, to be having this internal dilemma of like, I pay money for every month or every year to this insurance company for when I need them. Yeah. And now I need them. And I'm having this internal dilemma of, do I want to use it because I don't want to get dinged when it comes time for the renewal? So the general thought process is use insurance for big stuff for when you really need it. Otherwise, it's just more headache than it's worth, and you're probably going to end up paying more in the long run if you use your insurance, and you're limiting your options on who you could go to for coverage down the road. So fires are good ones, right? And so the question is, well, would you take a $500 deductible if you know you're not going to file a claim for less than $10,000, let's say? Right. So then we start saying, okay, well, I'm okay with the higher deductible because I'm going to save in premium dollars, and I wouldn't file a claim anyhow unless it hit a certain threshold. So that's kind of our second lever we can pull, is playing with deductibles. Third is playing with coverages. We have a litany of coverages that we recommend, that I always recommend for investors and for homeowners on certain coverages that they should have. You can start peeling those back. I don't like to do that because if I'm recommending the coverage, if I like the coverage, it's not something I want to get rid of. So maybe I can adjust the limit. And that's kind of our fourth option, is adjusting the limit on the coverage. So let's say State Farm comes to you and says, Pierre, your house is going to cost $600,000 to rebuild in the event that it's a total loss, it burns to the ground. You might be able to go to State Farm and say, actually, State Farm, I believe it's only going to be $500,000, or I only want to insure it for $500,000. They might come to you and say, okay, well, in the event of a total loss, we're only going to give you 500 grand. So therefore, we're not going to charge you as much insurance because you're not as big of a risk as compared to the person that's same house, they're insuring it for $600,000. So those are kind of the four levers we can pull. And I gave you kind of the order in which I would recommend doing them in most favorable to least favorable.
Given that each claim is going to either raise your premiums for the next year, or if you change your insurance company, could prevent you from actually being accepted by that new company. Say you own many properties as a property investor, you're taking on more opportunities for you to have to file a claim with these additional properties. How do you protect yourself? How do you keep insurance with you taking on more and more claims every door you add to your portfolio?
Yeah, it's a really good question, man. And it's something you have to think about as you scale. So the bigger you are, the more power you have as an owner, as an investor with the insurance company. As you can imagine, you're Pierre, you're an individual. I'm Michael, I'm an individual. If I have my homeowner's insurance with a company and I own that one house, I might pay them $2,000 a year. Let's pick a number here in premium. If that goes away for that insurance company, not a big deal, right? If I decide, hey, I'm going elsewhere with my business, doesn't really make a big difference to them. Now, we 20x that, right? You now got 20 doors and you're a $40,000 a year client. That's a little bit more substantial. And so your insurance company might be a little bit more flexible with you because of that fact. The other thing that I want to mention here, Pierre, since we're talking about it, is I like working with insurance brokers. And an insurance broker is somebody that basically, just like a mortgage broker, they're going to go shop your policy around, your property around with different carriers they have access to, and collate and kind of negotiate on your behalf, and then come back to you and say, hey, Pierre, these are kind of the two best options we have. Which one do you want to go with? Now, the important thing to remember is that not every broker has access to every insurance carrier. In fact, they likely don't. So the insurance carrier, Pierre, that you happen to work with might have access to 30 different insurance carriers, but they don't have access to these 27 over here. And so asking an insurance broker, who do you have access to? What insurance companies do you have access to? Might give you some indication about whether or not you want to work with them. And then there are also carriers that only go direct. So like the State Farms and the Farmers, for instance, you as the individual have to go to Farmers or to State Farm. There are many other carriers out there that go direct, but that an insurance broker is likely not ever going to give you a quote from, because they're a broker. They're kind of a middle person. So you need to go direct. So when thinking about shopping your policy, leverage brokers, and then also leverage yourself and go direct to companies.
So you use multiple brokers if you want to get the full suite of
I have in the past.
Okay.
Basically to get a wider breadth or exposure to numerous insurance companies. That's the best way to do it. And there is going to be some overlap. And so you can tell them, hey, I'm working with this broker and they got me quotes from companies A through C. Do you have access to other companies that you think would be able to provide competitive quotes? Don't go to A through C because I've already got a quote from them. So that's not of additional value to me. But so the brokers, and especially if you have a portfolio, like trying to go quote 20 property policies yourself is kind of a pain in the butt. And so that's where brokers can really add a lot of value. And then they can negotiate on your behalf and like, look, Pierre's got 20 properties. he's a serious investor. He's been doing this for a long time. They can kind of go to bat and tell a bit more of a story on your behalf, which helps in your negotiating power as an owner, as an investor. Um, but to your question, original question of like the risk does increase. Like that's just pure math and pure statistics. You have one door, the chances of having a fire is, let's say, 1 in 100,000. Well, now you start adding doors together, you, you have more opportunity for those things to happen. Uh, and so you just have to kind of accept that risk, but also know that the more doors you have, the more diversified you are. And so the risk of having 5 fires at 5 properties is a lot less than having one fire at the one property that you own.
Cool.
Make sense?
Yep. Are there any other considerations we as investors need to be thinking about when it comes to insurance?
Yeah, I mean, absolutely. I would look at natural hazard and natural catastrophe zones if you are going to be investing um, at all, whether you're new and whether you're seasoned and you're growing a portfolio. Like natural hazards and insurance are driving purchase decisions like I've never seen before. And believe what you will, but like the climate is not getting friendlier. These natural disasters continue to get more extreme with time. Wildfires are becoming more pervasive. And so it's important to understand that if you're going to be investing, you want to understand what your exposure is today, and try to do the best you can to forecast. And I know that's really challenging, but like as an example, if you're on the cusp of a hurricane zone or on the cusp of a wildfire zone, do you now become involved in that zone 5 years down the road? Possibly. Like that's just something that you want to be aware of. So I personally, my personal investing thesis and mantra is I don't invest in flood zones. And I'm much more willing to take risks when it comes to earthquake, a little bit of wildfire. I don't like to have much wildfire exposure, but I invest in California, and so it's like you can't really get away from that. And so if you're listening, you're like, Michael, my entire portfolio is on the coast of Miami. Like, what are you talking about? I can't mitigate against this. Like, you want to look to understand what are the things you can do. Can you harden your property physically because you can't move those properties, or do you want to think about divesting your portfolio? Because the other thing you have to remember is like if insurance is expensive for you, it's also going to be expensive for the next person that comes in and buys this. And so real estate is valued based on cap rates, and cap rates are a function of NOI, net operating income, and insurance is one of the expenses that is calculated in NOI. And so if your insurance goes up 5x, your NOI just took a massive beating. And so the value of that property has now significantly plummeted. So these are real things that I think in the past weren't on people's radar and weren't driving purchase decisions, but they are today. Like I just went and got a refinance done last September and my insurance was through the roof. And so the lender's like, sorry, dude, like we can't lend to you as much as we originally thought because your insurance is outrageous. I've since changed insurance companies and gotten away from them. And part of what was drove that is I was held captive because I couldn't because I had 2 losses on this building. I couldn't go anywhere else. So I was stuck with this insurance company paying what they demanded, and I had to have insurance because the lender required it. So I'm stuck handcuffed here paying these outrageous premiums, which then drove the value of my building down significantly, which then affected my refinance. So all these things like are connected, and insurance is having a pretty massive chain reaction in the industry, that if people aren't feeling yet, they absolutely will.
Okay. So when you are looking and researching into a new market, are there any particular resources that you can use to determine whether or not it's a high risk area for weather and disaster? What sort of uh, research resources are available, or what do you look at when you're looking at a new market?
Totally. So FEMA flood maps are publicly available, so you can see existing flood zones today. Wildfire maps are also available. Earthquake maps are available. Hurricane maps, hurricane zones are available publicly. So I would just research and start Googling around natural disasters in insert whatever market you're interested in and see what pops up.
Okay.
And start talking to local insurance companies and local investors about what types of insurance and what types of coverages they're getting and how you might want to be thinking about that. Is I think the best advice that I have.
Okay. So you in the beginning you mentioned Florida, Texas, California. Are are those no-go zones for you? And if not, are where are the no-go zones in the United States for you?
Yeah, so I personally, I've never invested in Florida and Texas for those reasons. Exactly, is natural disasters. There are tons of places inside Texas and Florida that probably will never experience a natural disaster and are technically probably outside of those zones that we talked about and don't have that exposure. I'm just not comfortable investing there, and that's my own personal investing thesis. And so I'm not a Florida guy. I'm not a Texas guy. I'll take my chances with the earthquakes
What about
out
tornadoes?
here in California. What's that?
What about tornadoes? Kind of that tornado alley
Yeah,
thing.
so tornado is typically going to be a covered peril
Okay.
as part of a standard insurance policy. That's wind damage, and so that's going to be covered. Those tend to be looked at a little bit different from a deductible perspective, but those tend to be covered as part of a general insurance policy. But that's a great question that you should be asking anybody that you're going to get a quote from. But so yeah, the tornadoes do kind of scare me as well, and so I try to avoid tornado alley. So where I invest in the Midwest, Ohio, and Kentucky, pretty benign when it comes to natural disasters, and so that was very much intentional. And so I kind of layered on all the things I was looking for in a particular market, and lack of natural disasters was pretty high up on that list because I come from the insurance industry. I see how those things play out when they do happen, and so I got scared pretty straight to say, okay, let's steer clear of some of that stuff.
Cool. Hey, that's all of my questions, but I have one more kind of fun question. Maybe it not might not have been fun for you in the past, but can you tell us what your worst insurance claim has been, or like the worst disaster that you've experienced as an investor through the years?
Oh man, talk about a gut punch, Pierre. You're undoing a lot of years of therapy. I just want you to know that in that one question. So we could do an entire episode about this, but basically, short story long is I was in the midst of a development project where I was converting a mixed use building. It had 4 units residential and 4 units commercial. I was converting it into 15 units residential and 2 units commercial. So a pretty big overhaul in this building. I was in the course of construction. I had two fires in the building 1 week apart, and it was just awful. So like I couldn't progress on the building because it was an active insurance investigation. Insurance was jerking me around. So that's when I went and got the public adjuster. And then in the midst of all this, the pandemic hit, which shut down everything as we know. And so I had to go to court to fight the insurance company, but I couldn't get a court date because of the pandemic. And then we had a court date, but nobody could log in. And so this was like a 3 year battle that I was locked in with this insurance company. And all the while, my public adjuster was like, dude, don't touch the site because that's evidence. Like if you build over it or cover it up, like that now we don't have damage to show, and so we can't use that. And so I was like, oh my god, all the while I have a mortgage to pay on the property and a construction loan. No progress is getting done. It's like it was an absolute nightmare. And at the end of the day, I mean, I got hosed. I got totally hosed by the insurance company. It did not end well. And so there's two pieces of the claim. There's the physical property damage piece, which is okay, you have to rebuild the property to its original state. And then there's the business, they call it BI, business interruption or loss of income, is basically the income that you lost out on because of the event that was covered. So on the property side, I made whole. I was made whole. That was fine. But it was on this lost income side that I just got absolutely hosed. And basically what happened is I said, look, guys, if the fire hadn't occurred, I would have finished the project a year ago. And so there's a year's worth of income that I lost out on. And the insurance company said, no, you haven't made much progress. You wouldn't have finished this project a year ago. You're only entitled to 2 months. And I'm like, yeah, but I couldn't make progress because I had my hands tied because it was an active insurance investigation. Like, what do you not see about this? So it was just a convergence of awfulness and really crummy timing, and it was awful. So I don't wish that on my worst enemy. It sucked, but you become resilient through these types of things. And I came out the other side. And when I had another fire, by the way, I knew exactly what to do, and that process was much smoother because I was a lot more experienced and well versed in how to navigate the claim side of things. And the whole irony of this, Pierre, is like I'm a licensed and professional fire protection engineer, and then I had two fires in a building, and I'm like, oh my god, like how can I ever show my face in the fire protection community again? Like this is so embarrassing. So that's by far my worst one. Two kind of that collided into a single claim.
One more off of that. What would you say your biggest takeaway from that whole experience was? Is there anything that we can uh, edify ourselves with from your experience through that?
Yeah, it's the power of a public adjuster.
Okay.
That was the biggest thing for me. I at the time I never had an insurance claim up to that point, and so I again having been in the insurance industry for my entire career, I was so surprised it wasn't something I had come across before. But if you don't have claims, like this is a public adjuster is not someone you just meet on the street randomly at a cocktail party, or whatever, and you ask someone what they do, and they say I'm a public adjuster. Like there are very few of them in the country, and so it's not something that you come across regularly. And so I cannot emphasize enough how impactful and important they are when it comes to insurance claims. And again, early on in the process, have that conversation. Then you can decide if things are going sideways to get them involved. You might not need them. I hope that's the case for you. It wasn't for me. I definitely needed them, and I wish I had involved them sooner. The outcome would have been even better for me with those claims, like it was in the next one that I had, where I got them involved from day one. That was pretty smooth sailing.
Well, thanks for reliving your trauma for us here.
Yeah, my pleasure, man. And great questions, great questions. And again, if you've had an insurance claim, I would love to hear about it. Drop us a comment. If you are in the midst of a claim or know someone in the midst of a claim and are looking for a public adjuster, please drop us again a note in the comment section. Be more than happy to help you out and connect you with some great people in the industry.
All right, everyone, that was our episode. I hope you all learned something from it. I know I did. Please like, subscribe, leave a comment. All of that stuff really helps us reach more people, and we will catch you on the next episode. Thank you.
Happy investing.